I apologize, everyone. Let me bring this up here. Okay. So welcome to our AMA. Again, I apologize that we're starting so late due to my audio issues. So I'm Vita Shoka. I am one of the developers on the Pana project, and today I'm going to be leading our AMA. And so there are a few things that we would like to talk about today, and a couple of them are we're going to be looking at what is parametric insurance. So one of my focuses is I want to make sure that everybody understood the difference between parametric insurance and traditional insurance. And then I wanted to talk about how our Assurance NFTs are different than traditional parametric insurance. And then we wanted to finish up with the Pana token launch and some details that we wanted to give there. All right. So first, I just wanted to give up a little explanation here of traditional insurance versus traditional parametric insurance. So a lot of people are mostly familiar with traditional insurance. These are things like your auto and your home policies, and they are one size fits all products that are based on your asset that you're insuring. And so they come along with deductibles. There's always exclusions. So in the case of an auto policy, if you were to cause the accident, there would be a reduction in your return depending on the damage that was caused. There's also the damage that is being assessed by a company representative to determine actually how much you're going to get back. So in this case, let's say you had a $15,000 car, but it's a few years old. They're going to try to minimize that payout as much as possible by depreciation for your vehicle and basically anything that they can find to be able to reduce that. In addition, there is no guaranteed payout because it is determined by an assessment. And so it is possible that you could not receive a payout or the amount of payout that you would expect. In addition, if you stop paying your premium, the policy will be terminated, and you'll have to get reapproved for that policy. The main focus of traditional insurance is to help people recover, but primarily with traditional insurance companies, big insurance companies, it's a lot about building wealth for that insurance company. The possible exclusion to that, or at least it's a little bit less, are mutual companies. So mutual companies are much less expecting to make profits, but ultimately they are looking to cover their entire policy base with the funds that they receive. And so they do need to focus on minimizing payouts. Also, that in traditional insurance, you have delayed payouts. So what I mean by that is your payout is determined based on the assessment, and depending how busy the assessors are, they, you could be a number of months before you're going to get your payout. Now, I worked for a mutual company for a little over a decade, and just to give you an example of this, we had a heavy windstorm in our area, and it is a local insurance mutual company. So a lot of the damage that happened were these microburst windstorms, and they destroyed a ton of fences and tore roofing off. There was a lot of trees that came down on houses, and there was a lot of damage that was caused by this windstorm. And we had, I believe we had 15 or so assessors that would go out and assess the damage. They would then have to go through all of their estimates and get things approved. I think that the last payment out to an insured was somewhere around 8 months after the incident. And so we really prided ourselves on trying to do these things fast, but when you get an influx of multiple hundred claims, it's really difficult to do. So that's traditional insurance. Now, traditional parametric insurance is a little bit more I wouldn't say necessarily advanced, but it's harder to wrap your head around because you are insuring, but you're not actually insuring assets. So what you're insuring is you're insuring based on an actual payout. And so, and this is in an area, it's usually a geographical area, and they try to minimize that down to the smallest area that makes sense. So let's just say you have a home and you have a business that is in a warehouse next to the home. You could have a parametric insurance policy that would actually cover both of those, so that in the case of a wildfire, or in the case of wind or flooding, you would end up getting a payout to cover both of those assets and be able to make those claims. So the way that the insurance company manages that is, what they do is they have an index profile that is built for the region that you are wanting to get the insurance on, and what factors you are expecting to have trigger that insurance policy. And so it has nothing to do with the actual assets. Your assets are only covered in the mind of, I need to know what my assets are worth and what it's going to cost to replace them. And when I set up this parametric insurance policy, I need to make sure that I am, at minimum, signing up for a policy that is at that price point. And then there's always custom payout provisions. So these can have exclusions. These can have various things there that would potentially make it so that you would not get a payout, so that they can prevent themselves from either insurance fraud, or in the case of something like wind speed, it would have to be over a certain duration. There would have to be a sustained wind speed. There's a number of things that would be adjusted to be able to trigger that parametric insurance policy. And what I mean trigger is, this isn't based on a loss, this is based on those actual terms that are set. And so if the wind speed is over, let's say, sustained 75 mile an hour winds, sustained over a period of time, then you could claim your insurance policy at that point and get your payout. Now, the payout is always based on the terms. Like I said, it is not factored by the actual loss, which is can be the downfall of these insurance policies. If you were to have a parametric insurance policy, but it wasn't going to cover that home and warehouse, when it pays out and you had a total loss, you're only going to get the payout of that amount. Now, the difference between these two with parametric is it's a guaranteed payout. As long as the triggers are triggered, then you're guaranteed the payout that you signed up for in the policy. They do not reduce it based on an assessment. There is no way that the insurance company can reduce that payout. And because there is no assessment, the payout is typically within 30 days. The only thing that the insurance company has to do is make sure that those terms or those triggers were actually triggered. And once they validate that with a third party, they use things like, weather reports by third parties. They try to keep it to outside of their company so that there is no thought that they're going to be impacting by their decisions. And so, but they try to turn that around really fast because it is a little more cut and dry in this case. There is no estimates. There's nothing to that effect. Now, also, just like in a traditional insurance policy, if you stop paying the payments, the policy will be terminated. And if you wanted to get a new policy, you would actually have to go through the entire process again, just like with an auto or a home policy or an asset-based policy. Again, this is built to build wealth for those insurance companies. This traditionally has not been super successful for most insurance companies because when an event happens, a lot of times the amount insured is so much higher than what they have available that only a certain number of people can make that claim during that event. And so it's just not, from my understanding, talking to insurance companies and working with them there, it's just not been that successful. They've had a hard time doing it. And I know a lot of that ends up being that they are trying to build wealth. So they don't want to empty their entire treasury to make those payments, those payouts. So that's part of the issue. And then these are in a complement to be, or meant as a complement to traditional insurance. Sometimes people will get both types of insurance, assuming that there's not an exclusion in their policies for this. That way, here where we are in Utah, there's a main fault line that runs across our valley, and it's expected that when there is an earthquake, it's going to be a devastating earthquake. And in that case, or because of that, a lot of the insurance companies do not actually offer earthquake insurance because it is a guaranteed total loss when that occurs. There are a few insurance companies that do offer it, but it's at a very, very high premium, but most do not because they don't want to take that risk. So what people can do is get a parametric insurance policy that would cover a loss if there was a X magnitude earthquake. And this is one of the ways that people have gotten around insurance, traditional insurance policies to be able to be covered for earthquakes. Here in the U.S., the other people are planning that the government will bail them out. So, which doesn't always go well, but that's an example of where parametric insurance plays its role. So now what I'd like to do is talk about our assurance NFTs. So this is the big focus of our DAO. What we would like to be able to do is offer parametric insurance in a sustainable way. And with NFTs having back contracts behind them and being able to put money into them, we've come up with this concept of assurance NFTs. So in our funnel here of our process, if you remember from our last AMA, I kind of skipped over a number of things, but I feel like this is the one piece that I'm most excited about, and I think will make the biggest difference and set us apart from what other DAOs are doing. So let me kind of give you a rundown of what our assurance NFTs are. So if you've been involved with Web3, you know that you're able to, assuming that people publish code, you're able to see the contract that is backing the NFTs. And so in our case, all of our NFTs will be open source, so they will the source will be posted to Etherscan, Polyscan, wherever those assurance NFTs are deployed. And participants will be able to look through that code to see if there are more to ensure that there are not any loopholes. This is going to be this allows us to be able to be very transparent on what the terms are for those assurance NFTs. Now, with those terms, they are going to be programmable based on different events. The idea here is that we can create a number of NFTs that have different triggering events. And so those contracts would be slightly different to each other, and you'd be able to see what those actual triggering events are, and at which time you would be able to burn your NFT and be able to get back your premium and any other funds that come along with it. So in the assurance NFTs, we have, you will pay a premium to be able to participate and and be eligible for the payout when the event occurs. And behind these NFTs are disaggregated treasuries. So these treasuries are separate from each other. So each group of NFTs is going to have its own treasury. The DAO is going to have a separate treasury that when we review bonds and staking and things, that those funds will be just in the DAO. With these NFTs and these disaggregated treasuries, they any premium that you pay or that participants pay goes directly into that treasury. It's not available for any other Assurance NFT collection. And so the funds that are put into it are isolated to it, is what we mean by disaggregated treasuries. And so when there's a payout, the payout is based on that treasury and the premium that's been put in. Now with these, we are going to be accepting premium in stable coins so that we're not working with highly fluctuating tokens. This ensures that the funds that are put in are stable funds and able to be in the treasury for future payouts. So now in our case, because we are doing this programmatically, what we're going to be able to do is if someone ceases paying their premium, they can start paying their premium again at a future time. Let's just say that you have a couple months where you can't you need to stop paying premium. Well, the policy doesn't actually liquidate anything like a traditional policy where you would have to then sign up again and get approved again. What we're going to do is once you start paying premium, you have to pay premium for a minimum of 90 days to be eligible for a triggering event. So there's a couple reasons for this 90-day waiting period. One, and the most important one, is so that if it's monsoon season and the Assurance NFT is tied around rainfall, you can't just not pay premium for 6 months and then start paying premium for 1 month and get a payout. We want it to be fair for all participants, and so you would have to be paying that premium for 3 months so that you would be eligible and actually be putting into that NFT. The hope here is that it would allow people some flexibility when they need to not pay premium, but for those that are going to stay within the or are going to be able to stay working on the or putting funds into the NFT, they will get the payout when it is triggered without someone just hopping in at the very last minute. Now, one of the pieces that we are going to be offering will be lending against the premiums that you put in to the NFT. So this is going to follow the principle that has been built by other DeFi programs or platforms, and allow you that when you put in your premium, you can now lend against that premium to go out and use it in other DeFi platforms. or even inside of the Pana project. And so this is a big part of DeFi, Web3 DeFi, that is being used. And we'd like to offer that so that people's funds are not just locked up inside of an NFT and unable to be used for anything else during that time. The goal here is we want to be able to create wealth for the syndicate participants. And so a syndicate participant would be anybody who is participating in the NFT itself. So if you're paying a premium, you would be a syndicate participant. So that would be anywhere from the example I give would be just one rupee to $1 million USD. Really, there is no limit or upper or lower limit to what can be put into an Assurance NFT to be a syndicate participant. And what we're wanting to do is for much of the populations, there is not a real way to build wealth. If you have not had previous family members or got real lucky, you have a difficult time building wealth. And in much of the world, there are not things like life insurance, or at least life insurance is not offered to lower income participants. So what we'd like to be able to do with these Assurance NFTs is have people pay premiums to them that are stable, that are going to stay there and be available for a parametric payout when an event occurs. And hopefully this will help generate wealth for anyone. There's been a lot of wealth that's been created inside of DeFi over the last few years, and a lot of it has been by whales that put in a lot of money and pull out a lot of money after they've gained a lot of rewards. And so in this case, we want it to be stable, we want it to be sustainable, and be available for anybody, regardless of their status in their population. So that's our Assurance NFTs, the basics there. What I want to go into now is the token launch. I know that this is what people get real excited about. So what we're going to do is we want to follow similar to a launch that a token called Giddy recently launched with. We would like to be able to get tokens out there as widely as possible and have it be as fairly as possible. If you've been involved in blockchain token launches, a lot of times the term fair launch is thrown around, and most times it's isolated to certain people for a period of time, and then the tokens skyrocket. So in our case, we want to try to put it out there and have it be available to people quickly and easily. So what we're going to do is you're going to be able to stake tokens. And so when you stake a token, we will offer some of the traditional tokens that you can stake, as well as we're going to offer Pana tokens or Pana DAO LP tokens or Pana and another pairing LP tokens. And when you stake your tokens with us, it will be staked into a public contract. It's going to be staked into where you can see what is available. There won't be any use of that token while it is inside of that staking contract. We're not going to leverage it. We're not going to distribute it anywhere. It is going to sit in that staking contract. And then what will happen is, based on what you've staked, you're going to receive Pana tokens. And these Pana tokens will be based upon what amount you have staked. And as long as you are staked, you will continue to receive those rewards inside of our DApp. Okay. Now, there will be different multipliers applied to each one of the staking pools, and those will be announced at a later time. But what will happen is, once a time period has elapsed, what happens is you'll be able to see through our DApp the tokens that are available for you to harvest. So tokens will get minted. They will, while you're staked, and you'll be able to see, based on my stake amount, how many tokens am I going to receive per day? And then you'll be able to, at any amount of time, you could do this every hour if you wanted to, every 24 hours. You can harvest your Pana tokens. And so when you harvest your tokens, that will transfer the tokens over to your wallet. Prior to that, they will be held in the, or they will be in the staking contracts, and they'll be transferred to you at the time of harvest. And so this allows you to be able to have something be built, 24/7. You'll be being awarded those tokens. Then what you can do after you harvest them, you can harvest them and then you can apply them either into a pool. That's why we're going to offer Pana and Pana LPs. You'll be able to take them, put them back into a pool, and gain more rewards. The hope of this is, or the goal of this is, we want to be able to distribute the token as wide as we can. And we want to prevent having whale impact by having this minting occur over time, rather than just somebody can come in with $1 million and buy a million worth of Pana tokens. And so the hope here, or the goal here, is that if a whale wants to come in, they can get rewards, but it's going to lock up their funds for the duration of this token launch. And then lastly, if you've been involved in DeFi over the last few years, the difficulty is, a lot of times early birds are rewarded much higher than people who come in later. And what we're trying to do is make it so that there is an equal distribution between early birds and the latecomers that come later. So the time of when this will be launched is yet to be determined. We are just going to continue building the community, and once we're ready for this token launch, we'll be extremely excited and announce that to everyone and send it out to all the platforms that we can. So that is all that I have right now for, at least in my slide deck, for our AMA. At this point, if you'd like to ask any questions, there's a Q&A channel that is available on Discord. And if you could post those questions in there that you have, and we can answer them as best as possible. So,
can you hear me okay?
Yes.
Okay.
Yes.
There's a question in there that probably is the best answer, but me and a few others were answering questions in here already just to help things, help the flow keep going. The questions match nicely with what you were also verbally going through, which was nice. So, but there's one here I just don't think can be written well. The question was spacing the question. Bindusar, where's that question?
I think it was about the ID over copper event, and I think.
Was it? Okay. Yeah.
And another one was. Just a moment.
There it is. Found it. So this is, I think it's the lending one. So
yeah.
Lending based on premium accumulation. If I put in premium, borrow and invest in some other protocol, looks like a double benefit for me. But will I get insurance covered for that period? That one I think needs a verbal.
Yeah. So yeah, the coverage is still outstanding, and to be able to trigger that, or to be able to, sorry, you there?
Yeah, it sounds like you're getting an echo.
Okay. So with it, to be able to burn your NFT and get that back, you're going to have to pay back anything that you have lended against it, and then you will be able to get that parametric payout and do with it as you will. So the policy will still be active. The policy will still be available to you, but you will have to go through that process. Do you want to add anything to that, Akrika?
Yeah, let me maybe comment on that one a little bit more. So I'll walk maybe through the use case. So some premium is paid into an Assurance NFT. Let's just say that it's $100. What happens is when you pay that premium, you're going to have Karsha equivalent to $100 placed into your wallet. At any time, you can take a loan out against that Karsha, and Karsha is a volatile coin. So it's a governance token, but it is volatile. So it may or may not be worth $100 over time. And we're not guaranteeing any price. I want to be very clear. But let's just go ahead and say that it's $100 just for the sake of this conversation. You then may want to take a loan out on that. There's no interest associated with that loan. What all that happens when you take the loan is that it locks your parametric contract. Okay. In other words, it means that your parametric contract is no longer available to you, and until you pay it back. But let's say it's $100 worth of Karsha at the time you take the loan. You could go exchange that for USDC. You could exchange that for DAI or whatever, and then go into another protocol, right? And then sometime in the future, come back, pay back Karsha. Maybe when you choose to pay back that Karsha, the Karsha price has dropped, to $50 for the same amount of Karsha. Well, you know what? Now it costs you a heck of a lot less to buy the Karsha to pay back your loan. You made a bunch of money in this other protocol that you went into, and as soon as you pay back your loan, your parametric contract is reactivated. Keep in mind you have to keep paying principal during that period, just like any other type of insurance policy. So basically what this does is it allows you to be able to get access to the premium that you've paid, because that really technically is your premium, right? I mean, this is your capital. And allows you to be able to then leverage it in DeFi and then come back and replace it against, restore what you loaned and get access again to that parametric contract. This is a wonderful, in my opinion, hedge because, and we didn't really get into it too much, but if the treasury size that you have access to has grown over the period of time that you had the loan, it could be very much in your favor to pay back that loan and then take the next parametric payout. These parametric events occur relatively frequently, so take the next parametric payout and thus you could have profited significantly. And again, just because I'm having these disclaimers out here, I mean, there's no guarantee of profits and there's no guarantee that Karsha would be inexpensive. It could be very expensive to restore that. And, I mean, these are all things you have to factor in, but the point is, we have a very simple solution for being able to get a parametric payout in the event that you're following just the very basic protocol for parametric insurance, but there's also very sophisticated hedging that you could do if you wanted to play a kind of a degen game with the protocol, and it offers both ends of the spectrum very safe, relatively safe. I mean, nothing's perfect, but we think it's pretty solid. And then on the other end, you know, it's more of a degen play, and if you feel like you know what you're doing, you could go ahead and play that game and potentially benefit significantly. So that's the way that the lending works. And we can get more into that, you know, at a later date. Some of that's in the documentation. It's not going to be, lending will not be available in the first phase of Assurance NFTs. It's something we're going to be adding as a second or third phase. But we are very excited about it because we think it opens a lot of doors for people. So we're just mentioning it today.
Okay, great. Thank you.
Other questions that were there, just trying to help you out, you know. I think we got most of the rest of the questions. We were kind of answering them as they went along. Me, Bindusar and Ashoka and others. So do we have, are there any others, Bindusar, that we missed?
Everything else is answered, Asrika. And I think if you can give more perspective on the goals of our launch to be better.
Yeah, as Vita Shoka mentioned, you know, we feel really good about our token launch in terms of leveraging the Giddy approach. We really like that team. They're brilliant. Like the trade-offs, their light paper that got posted in the Q&A channel. We are right now wrapping up the code for that token launch. The bonding and loss ratio code and those sort of things are all finished. We actually finished those before we opened the community. But we were still debating, somebody here asked whether or not we were going to do a copper launch. You know, we were debating on that. And we really want this to be as fair a launch as possible. We want to make sure that it's viewed as an asset, as a commodity. We don't want to trigger any kind of securities laws. And so the trade-offs that Giddy walked through, we feel are good trade-offs. And as a result, the current plan is to have more of a very simple commodity-based launch. It's fair. Everybody gets access to it. And the timing of that, though, will be contingent upon us finishing the code. The code's not terribly complex for something like that. It's very simple, like Vita Shoka was describing. There's, you know, people stake their tokens, but we don't actually do anything with those tokens. It's just a way to get access to Pana. But we need to build that. We need to test it. And then once we feel like we have enough participants in the community, we then want to launch it. That launch may last for many months, where we mint Pana for people who are participating. And then eventually we'll move over to bonding, and then we'll shut down the fair launch. So we don't have an exact date. I know that Vidashoka was teasing about when, hopefully soon, but it could be a couple of months from now. In some ways, we want to listen to everybody here in the community and do what you think is best. So if you have ideas, feel free to always share those in the different channels that we have and share your thoughts. We're not in a rush here right now. We want to build a strong community. We want to be patient and thoughtful. And in a bear market, sometimes these things take quite a bit longer to build consensus and to build community. And you know what? We're in this for the long haul. So that's what we're going to do. I don't know, Vidashoka, would you add anything to that?
Yeah, the only thing that I'd really add is just the big focus on being able to have it be as fair as possible. The big gain from Giddy has been that anybody can participate, and I think it's a great model that that they have created, and they've done their best to try to prevent whales. And I think that's a huge asset to a token launch that in the past hasn't always worked out in favor of the regular person. So. Okay, is there anything else? Any other questions? Anything we missed?
Like it.
Okay. Well, I appreciate everybody coming and joining us today. I apologize again for the late start. There's quite a bit of information we have in our Git book, and if you have the time, go ahead and look through those, the articles that we posted on LinkedIn and Medium. Those are great resources, and feel free to ask any questions at all in the Discord channels. They're available there. We're checking them all the time and trying to be able to answer any additional questions that people have. And I thank you for joining us today, and hope everyone has a good day in their respective areas.
Cool. Thank you, Vidashoka, and thank you, everybody.
Hey, thank you, everyone.
Thank you, everyone.